Let's keep it going here. We've got Mark Dow joining us, author of Behavioral Macro. He's here to talk some bonds and throw a little trade into the mix as well. Of course, you can find him on Twitter at Behavioral Macro, where he's got a private feed for traders as well. Mark, welcome back to the show.
Thanks, Oliver. Thanks for having me.
So the first thing that jumps out to me, Mark, is you describe the right now kind of consensus view or the causality folks have been discussing about rates in the market as being misdiagnosed. What do you mean by that?
Yeah, it's when you take a statistics class, the first thing they teach you is don't confuse correlation with causation. And really what we've been going through since COVID hit a year ago is toggling back and forth between our growth outlooks. Is the recovery going to happen? How fast is it going? How strong is it going to be? Is it not going to happen? How much are things going to slow down? And when we're positive about the recovery, become more positive, then we see the typical recovery names like banks and oil names do well, and bonds sell off on the prospect of a stronger economy going forward. Conversely, when people are worried about growth, what do? They buy the secular high growth names, impervious to cyclical fluctuations, and they buy bonds. So you see a correlation between lower yields and higher tech prices. But people mistakenly seeing that correlation assumed that the lower rates were causing the higher valuations because of discounting cash flows and things like that. But if you think about it, if you have a company that's growing 25%, 40%, 60%, 100%, who knows? Does it really matter what the discount rate is? They're going to be much more sensitive to that growth rate being 25 or 60 than anything else on the planet Earth. Everything else is a rounding error. So it's a little bit like people who say they're going to buy a really, really volatile stock for the dividend. We all know that's not a good idea because the volatility of the stock is going to exceed whatever dividend you may, whatever return you might get from the dividend. It's the same kind of misguided thinking. But when it becomes a narrative, it starts becoming self-reinforcing, and that's what we saw. And then finally, the story kind of popped. But it's really about this toggling back between better growth or worse growth, and the correlations that fall from that.
Mark, I think the one point there that's really interesting I want to hone in on is about the self-reinforcing power of narratives. Is you come at it from this kind of mathematical economic way, saying, look, as an investor, I'm not going to care too much about this move in yields ultimately if my company is turning out incredible growth. I come at it from a perspective of talking with people about the reasons they give me for buying things, and for 8 years, the most common reason that I hear is rates. And then when these things happen, to your point, it looks very real like that's the case. I mean, right now, our peaks and valleys in the NASDAQ over the past year line up like perfectly with real yields. So Are you saying that this is just a moment we're going to have to grow out of, and then people will realize, okay, we got it wrong. Maybe this is actually happening at the moment, but it won't for a sustainable period of time?
I think to some degree that's the case, but it's almost always going to be there in some measure because it's natural for investors to reach for stocks that are impervious to cycles when they're more pessimistic about the cycle. So they're always going to, and the correlation, we see this year, you reach for the stock that you think doesn't care about GDP. And then as soon as you realize, oh, wait a minute, GDP is going to be a little bit stronger, you sell that and then you buy the other name. So that correlation to some degree is always going to be there. But the narrative that the lower rates were causing higher tech multiples really was an ex post facto justification for people chasing higher stocks. Because mathematically, it really doesn't make any difference what the discount rate is on a company that's growing 25 or 65 or 100% a year. What really matters is that growth rate. That's the whole story for them. So
what do you think it'll take?
But it does matter, and this is an important point, Oliver. It matters whether or not the narrative is real. Because, I mean, think about it. Would you rather be long a set of stocks whose narrative is fake, but the stocks are going up, or stocks whose narrative is real and the stocks are going up? You want the one that's real, because at some point, a fake narrative can falter on you.
Mark, so let's say in a hypothetical situation, because we're just looking at where the tops have lined up with that move in real yield. Let's say if real yields keep going here, and it doesn't seem like from your notes you think that's necessarily going to be the case in the short term. But if we keep having this higher yield, at what point do you expect we might be able to extract ourselves from this narrative then? I mean, it would seem that then your logic would be eventually you could still have real yields moving higher, but this market will turn around.
And I think that's right. I think the yields can, because if you, time and time again, put it this way: a yield on the 10-year bond of 2% is way higher than where we are today, but it doesn't really scare anybody as a level. If we got there in 2 days, that would scare people, right? Particularly if people had profits to protect. And I think this is what happened. People started unwinding risk a couple weeks ago, mid-February. And as they did, the value stocks were doing well, the tech stocks were doing poorly, saw how the interest rates were moving, and we started to make a story out of it. And then it started to hit people who had positions in the fixed income market, carry trades on the U.S. yield curve, and they ultimately got forced to unwind. And when the panic came, when people started to associate the interest rate move with the economic outlook too tightly, we got our panic day last week.
Okay.
And that's when the positions pretty much cleaned out, and I think they're going to settle for a while. They're probably going to grind higher over time because the economy is recovering, and we have a lot of economic stimulus coming into the system. The fiscal stimulus is going to be very powerful, I think. So I would expect rates to go higher. But if you look back in history, there are plenty of times when rates are 4 or 5%. I mean, look at the dot-com bubble. We saw what growth stocks did then, and the policy rate was 5 or 6%. So the level isn't really a problem. It's just sometimes the speed from one point to its destination can scare us a little, particularly if we have profits to protect, and then we go into de-risking mode.
So, Mark, here's where it then seems that the question that we have to figure out as investors, if we want to be long stocks, is there potential for more quick moves to the upside like we got over the past couple weeks? What, in your mind, would be the types of events that could cause that? I know you just said that you don't think that we need to have another spike, that things could settle for the time being. But what could it be? Because last week also, even though the Fed didn't send us any signal that they were going to talk about twisting, tapering, or anything, as soon as Powell said that he wasn't going to do that, we got another leg of this whole thing. So is that going to be continuing to be a risk if he doesn't come through and taper, or is this right now purely an inflation risk? Go ahead.
I think it's really about the market that he said that in, and not so much what he said. People were already on edge because they were losing money on their carry trades in the fixed income market, and they were clinging to them, by their hanging on to them by their fingernails. And it just took one little push, and then some people sell, and then everyone gets forced out of their position. We were already in de-risking mode for some time, and usually those things, once they start, they kind of have to play out until people have reset their risk profile. So it's almost always more about how we react to things than what it was said. Because if you look on it, look at what he said on his face, he didn't really say anything. We just reacted to it and ascribed it to his words, but it was really, we were primed for that kind of a move.
So do you think, and again, this is kind of playing the psychology game, this is why markets are fun though, because if people are, even though Powell didn't say anything new and they still freaked out, if he doesn't say anything new next time, are they going to freak out again, Mark, or is it a certain point?
It depends on what kind of condition the market is in, right? So if the market is in a strong position, it's in an oversold condition, it's probably not going to sell off so much. But if it's an overbought condition where people are hanging on to clutching their positions, hoping that they're not forced, they don't get tapped on the shoulder and get forced to sell, or they don't get a margin call, then any little thing will scare you out of a position. So it's much more the initial conditions in a case like this than anything else. The Fed is not trying to rock any boat. They're just trying to, they really want to stand back now and let fiscal policy do its thing. The Fed has wanted fiscal policy to take the lead for quite some time, and it's finally doing that. And I just don't think the Fed wants to get in the way one way or the other. They want to continue to see the plumbing work well for the financial system and let things play out. Okay.
Hey, Mark, we already took you past the time. We're at the closing bell right now, but give me the 30-second home builders case, because I promised folks on Twitter you were bringing a trade.
Basically, there's a backload. People still have PTSD from the last crisis, and the home builders aren't building out enough supply to meet demand. Backlog is massive. Valuations are in the 8 to 12 to 13 range, and earnings are growing pretty fast. PEG ratios are low. The charts look awesome. And stabilization of interest rates. They don't have to go lower, but if they just don't go higher very fast, they'll do really, really well. Plus, demographics are a big factor behind home builders right now. The millennials are coming online really hard.
That's a good 30-second drill. Appreciate you joining us as always, Mark.
My pleasure, Oliver.
Thanks a lot. Mark Dow joining us from behavioralmacro.com.